Folks, Tom Lee has done it again. He just came on CNBC and he shut all of his critics down with just a few facts and objective numbers. He literally left everybody speechless by using data, facts, and logical arguments. And there's a lot of info, a lot of value there for long-term investors I want you to pay attention to. So don't click nothing, don't smash nothing, don't buy nothing. Let's listen to what Tom Lee said. Check it out.
You still think that they could go up 40% by year end?
Yes. John, for small caps to rise 40% means that the PE, the median Russell 2000 stock, goes from 10 times to 14 times. So it's not asking the market to provide some magic and a huge revaluation. It's actually just saying small cap stocks, which have been left for dead largely because the Fed's been tight for almost 2 years, as they start to normalize policy and as mergers pick up, its merger activity has been accelerating this year, and it should really strengthen because it's a sign of CEO confidence. All of these flow through to benefit small cap stocks, and it's not like smaller companies are growing slower. I know people post all these stats about small caps losing money. It's mainly because of the biotech components basically don't make money, and that's the largest cohort of stocks in the Russell. But the Russell 2000 median earnings growth is almost 700 basis points faster than the S&P, and top-line growth is almost 400 basis points. So you're getting better growth, lower valuation, and I think the catalyst is now when the market is convinced the Fed is embarking on a rate-cutting cycle. A 40% move in small caps doesn't mean the rest of the market goes down. I just think that's going to highlight that the market is broadening, which is something we all expect, but it's also basically doing a risk-reward analysis, which is, look, I think if you can get 18% earnings growth and pay 10 times earnings, perhaps that's a good risk reward. And I think money that's on the sidelines, or people who've been thinking bonds are going to be, and cash is a place you want to stick for the next 5 years, but if the Fed starts cutting, they're going to look for places where there's good risk reward. And I think that's small caps. So it's not like I would say sell NVIDIA to buy small caps. I think NVIDIA is still a long-term buy. I don't think the Fed has to make major cuts. It actually just has to. I think the market narrative that would be the best for small caps is the belief that real interest rates are too tight now, 5.5% versus inflation trending towards 2%, and getting rates back down to a neutral rate of 3%. If the market believes that, they don't need the cuts to be front-end loaded, but they have to believe we're going back towards neutral. I think that'd be a huge catalyst for small caps.
He says, look, guys, the median PE right now on the IWM, the small caps, is 10. For us to go 40% up, we need to go from 10 to 14 PE, which is not that crazy, especially when we are heading into a cutting cycle by the Fed. And he's also adding one more interesting point, and he's saying, look, beyond the PE ratios, beyond the price to earnings, look at the earnings growth and how much these companies are getting better every single year. There's a lot of losers in this index, which people knock on, but he says, look, guys, the losers in this index are by design. These are the pharmaceutical, the biotech, the companies that are basically losers until they explode out of the stratosphere. It's a binary game, and only about 10% of them will actually do it, and 90% of them will fail. But that's how the biotech game works. If you carve out biotech, the earnings growth on this index is even faster and bigger than the S&P 500 at 10 PE versus the 30 PE we have on the S&P 500. And he's also talking about the fact that at this point, rate cuts by the Fed are certain, and I agree with him. And that, by definition, will have to drive valuations of these companies, because if you look at the principle of a DCF, the discount rate in which you actually bring to present value future income goes down. On top of it, he's talking about the fact that the whole game of chicken between the money on the sideline and this market still hasn't been resolved. A lot of people are still sitting on a lot of money on the sideline, having made the mistake of not getting in the market in 2023. All this money, $6 trillion, is parked, and they're waiting for an opportunity to jump in. At some point, they're going to run out of time. Once the Fed starts cutting rates, the branch they're sitting on, that 5% they're getting with zero risk, is going to start getting lower and lower, and they will be forced into the market. And what he's saying, that they're going to pick the companies that have the most amount of upside. They're not going to buy the companies that have already gone through exponential growth like NVIDIA. They're going to look for opportunities, mispriced opportunities like the IWM, which has been lagging the entire index. Also, he's talking about the fact that we have the idea of a cut absolutely wrong. People think, 0.25, 0.5. He says it doesn't matter. All we need is for the Fed to signal to the stock market, we are beginning a cut cycle. That's all. And from that point on, the narrative will change and the IWM will start running. Of course, he does mention that a recession can be a huge risk for this, because if the rate cuts come in a recessionary environment, they're not going to help. Statistically, historically speaking, if the Fed cuts rates too late, the market still tanks. And that's definitely a risk. And that is what's holding the IWM still down. What Tom Lee is saying here is very simple. We have a lagging asset class, the small caps, that's been completely left behind and ignored. We have cheap valuations, good earnings growth. We have rate cuts, a decent economy. And even though everybody will win when the money will become cheaper, the upside is bigger with small caps than the mega caps. That is his thesis. Now, why do I think he's right fundamentally about that specific idea? Well, look, you have to understand the IWM, because we keep comparing IWM to S&P 500. Microsoft and Apple are bigger than the entire IWM index. It's a small index. So an influx of money into a small index like this can absolutely send it to the stratosphere. The other reason is that while we've seen the S&P 500 recover from the initial rate cut drop and run 40%, the IWM has been literally left behind. Almost nothing, almost flat. And while we have 30 price to earnings ratio on the S&P 500, the average, not the median, the average on the IWM is 17 PE. It's more attractive going into this rate cut cycle, which is more beneficial to small caps. And if you look at history, small caps give you 26.6% for the first 12 months after the first rate cut. And if you don't believe Tom Lee, just look at the data itself. When the Fed started hiking rates, we were pretty much zero. We went above 5% from February 2022 to August of 2023, right? That whole time basically saw a massive drop in the IWM, minus 20%. In the same time frame, the S&P 500 dropped 2%. So clearly, the IWM is more sensitive to interest rate. And you can see it, 20% versus 2%. So it's more sensitive and it's been left behind, creating a massive rubber band effect. And now that we have the Fed starting to cut rates, that gap will absolutely have to close unless, of course, we get a recession. We'll talk about that in a second. And the reasons for that are quite simple. The small caps, the IWM, the Russell 2000, well, it has a lot more debt. Twice as much as the S&P 500. And while the S&P 500 is mostly in fixed rates, which means that it doesn't matter what the market does, we pay a fixed rate. The IWM is at 90% floating rate, which means they're not just more sensitive, they're a lot more sensitive to interest rates than any other stock that is in the S&P 500. And that has to be reflected once rates come down. Now, even if you look at the DCF valuations logic, if you look at the rate cuts, if you look at the debt structure, if you look at the lag, this whole idea and all this money on the sideline, basically trying to figure out where we can come in, what you get is a very interesting setup. While the entire market is going to benefit from lower rates, more money, cheaper money, the economy will do better, and then the stock market will do better, the IWM, the small caps, are in a much better position versus the rest of the market. And while everything will have to go up, the IWM are positioned in the best possible spot, assuming, of course, we don't get a recession, because that is the big question. And that is the reason why the small caps are still to this day behind. People ask me, well, Tom, if everybody knows this, why is the IWM still so behind the S&P 500? Why hasn't the market that is so good at pricing in future developments started pricing that in? Well, because a lot of people fear that a recession might happen. And if a recession comes because of unemployment data, the SAM rule, all the stuff we heard, if there's a legitimate recession fear here, that's a massive risk that will prevent potentially the IWM from making this run. And you have to acknowledge that. You can't just say, well, Tom Lee promised me I'm going to do what Tom Lee says. No, there is a legitimate risk that he may be wrong. There's no certainty that he is right. You have to take that into account. Especially if you look at the rest of the market, because a lot of people say, well, Tom, why not just sell my portfolio, sell the S&P, sell NVIDIA, sell everything I own, and just buy small caps for the next 6 to 12 months? Because there's no certainty he's right. There's no certainty. And you want to do this while the AI rally that's going to last for another 3-4 years, going to send the stock market, the S&P 500, the NASDAQ into the stratosphere, you want to sell out of that asset class? You're crazy. Even Tom Lee is telling you, don't sell NVIDIA. You're crazy to do that. So the idea here is very simple. Buy and hold long term. No jumping in, no jumping out. Don't sell out of your portfolio just to buy IWM right now and then come crying tomorrow because you got screwed by the market. Watch what the top investors are doing. We have a very famous study with portfolios of $1 million and above. Don't watch the billionaires. What the billionaires are doing is not relevant to you. They're managing risk. Watch what the 1 million portfolio guys are doing. 8% per year of selling. 92% of the portfolio stays put. Not selling in panic. In 2020, when the entire market dropped like crazy, when people thought the world was ending, all of them stayed in the market. 99% did not sell out of their portfolios. Lots of non-individual stocks, bonds, ETFs, whatever that may be. The whole setup here is very different than the average retail investor. And that is why, despite the fact that the S&P 500 rises every year, if you slice a 10-year vertical, most retail investors lose because they don't understand they have to slow down, dollar cost average, and be okay with missing some upside. It's okay. Be okay with taking a few hits while you stay in the bad market. Trust the process, stay focused. 90% of this game is mental, I promise you. All you gotta do is have patience and discipline. That's all. If you understand how to find companies, businesses, not stocks, businesses that will be dominant for the next 10 years, and you hold on to these for dear life and don't sell for 10, 15 years, it's a cheat code. It is literally impossible to lose money in. It's a lot better than speculating the market and jumping in and out. Because look, I've showed this principle before. Miss out on 10 best days over 20 years, and that 9.5% per year drops to 5.3%. Miss out on the best 20 days over 20 years, you drop to 2.6% from 9.5% returns. So just missing the top 20 days is going to wipe you out over 20 years of investing. Now, that alone is a good lesson to you why Tom Lee, when he talks about long-term bullishness, is right. Because what Tom Lee is saying, if you've picked good companies and you stayed in the market long enough, there is no way you're not going to make money. And I agree with that 100%. Let me show you. In 2023, we've made kind of a simulated portfolio of 9 stocks. I've covered 9 stocks on the channel, which I was bullish on. Those 9 stocks are Google, Tesla, Palantir, CrowdStrike, Bungie, SoFi, ANET, SMCI, and NVIDIA. Go back and watch all those videos. They're still on my channel. Now, these 9 stocks we covered and were bullish on in 2023 so far has driven us 112% since the beginning of 2023, while the index, the S&P 500, did 43%. In fact, my own portfolio, which you all know by this point by heart, I hope, which is 40% Palantir, 40% S&P 500, and 20% Tesla. So S&P 500, Tesla, Palantir. 40%, 40%, 20%. My own portfolio is up 165% from January 1st, 2023 to right now. And I haven't done it with timing the market. I haven't done it with guessing what the market will do. All I've done is pick good companies, add in the S&P 500, and hold on to dear life, and just don't sell, and add to it every single month and add more when the market drops. And if you want to get better at this, join the academy. I'll teach you how to pick good businesses, how to be a long-term investor. I'm not going to teach you stock trades and give you trade alerts and none of this crap. That doesn't work. I'll teach you the right way to do this so you can do it for yourself. The academy has been closed for a few weeks. I've been on vacation. We reopened it yesterday for 10 spots. 7 are gone. 3 are left. The next cycle is in October. If you make it in time, you can get it. If not, I'll see you next time. Peace.